As Benjamin Franklin said, nothing in this world is said to be certain except death and taxes. Also, Brad Pitt said that in Meet Joe Black. Any Brad Pitt fans out there? We all know we will eventually die sooner or later. Sorry to burst your bubble if you weren't aware of that yet. And we will all pay taxes, but we can pay less in taxes if we're smart about it. Today I'm going to share with you how to pay $0 in taxes and also 5 ways to reduce your taxes. Americans pay more than $525,000 in taxes over their lifetime. There's a few things I can think of that I would rather spend $525,000 on than taxes. Let's be smart about our money and reduce the amount we're paying in taxes. I am Tiffany Thomas with WealthyTiffany.com, and I achieved financial freedom at age 38. And if you are looking to achieve financial freedom at a young age as well, hit that like button and hit the subscribe button, and we're going to dive right in. All right, if you're wondering how to pay $0 in taxes, I'm going to share that with you first. I'm going to share the tax rates for this year for 2021. So this is what you'll be paying when you do your taxes next year, but it's just a little bit higher than 2020, so it's pretty comparable. So you can see there are different tax brackets depending on how much money you are actually making. If you make $0 to $9,950, then you're going to pay 10% in federal taxes. And the way to pay $0 in federal taxes, at least, is to write off that $9,950. That would be the lowest tax bracket you could be in, so that would be the easiest amount to write off since it's the lowest amount. And as you can see, the more money you make, then the more you'll pay in taxes. So if you're making $9,951 up to $40,525 per year, you're going to pay 12% in taxes. And then you can go up from there. So $40,526 to $86,375, you're going to pay 22% in federal taxes. And we'll do one more, $86,376 to $164,925. You're going to pay 24% in federal taxes. And then it continues to go up from there. And this is for single filers. So if you are married or if you're filing jointly, these numbers are going to be a little bit higher. So we'll just do a quick glance. So if you are filing jointly and you make $0 to $19,900, then you're going to pay 10% in federal taxes. So you could figure out a way to write off this $19,900 and then pay $0 in federal taxes. And you can see it goes up from there. So the next bracket would go up to $81,050. You'd pay 12% in taxes. And then up to $172,750, you're going to pay 22% in taxes. And it continues to go up from there the more money that you make. And just as a side note, the tax brackets continue to go up, but the amount that you originally made, so if you made $19,900, you're going to pay 10% on that amount. And then anything above that, then you're going to pay the 12% tax rate up to $81,000. So you're not going to be taxed at 12% on your full $81,050. You're going to pay $1,990 since that is 10% of $19,900 plus 12% of the amount over your $19,900. Which is kind of nice because that way you can at least keep your taxes a little bit lower since you're not paying the full amount of money that you're making in the highest tax bracket. And if you're thinking, I know there's state income tax that I have to pay. Well, actually, if you live in 9 certain states, then you do not have to pay state income tax. Those states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. So if you pick one of those states to live in, you do not have to pay income tax. That's the very short version of how to pay $0 in taxes. And if you're thinking, Tiffany, you're crazy, there's no way that I can write off that amount or even live off that amount. You're right, I might be slightly crazy, but I'm not that crazy. So let's talk about ways that we can reduce the amount of taxes that we pay. In order to do that, we're going to need some tax deductions or some tax credits. So let's define both of those. Tax deductions allow you to deduct from your income before you calculate the amount of tax you owe. This lowers your taxable income, ideally pushing you into a lower tax bracket, which we looked at earlier. And tax credits are dollar for dollar reductions in your tax bill. You subtract tax credits from the amount of tax that you owe. And just to give you an example on the difference between a tax deduction and a tax credit, I want to talk about President Biden's proposal to change how the 401k works. Essentially, he wants to change the amount that you're contributing to your 401k from a tax deduction to a tax credit. So let's talk about the example here. An employee earning $70,000 a year at the 12% tax rate can put $10,000 into a 401k, and the tax savings would be $1,200. But a higher earner making $450,000 annually at the 35% tax rate, who puts the same $10,000 in a 401k, gets a tax break of $3,500. That is how it works now. So you get a tax deduction, so it would actually lower the tax bracket that you're in. His proposal would end that tax deduction for contributing to a 401k and replace it with a tax credit. He's basically proposing that it would be an equal tax break no matter your income level. His proposed tax credit is 26%, whether you're making that $70,000 or $450,000. So if his proposal does get passed, then everyone would receive a 26% tax credit. So that wouldn't lower your income level. But using that same example, if you were to invest $10,000 into your 401k, then you would get a $2,600 tax credit. And he's suggesting to even make that refundable. So if you didn't have enough to write off that $2,600 on your taxes, then you would get refunded the rest of the amount. And we'll see what happens with Biden's proposal. But if you're getting a tax deduction, then you're able to reduce the amount of income you're being taxed on, putting you in a lower tax bracket. And a tax credit won't lower the amount that's going to be taxed as your income, but you'll receive on the kind of back end a credit on your taxes. But either way, we want to get as many tax deductions or tax credits as possible. So let's talk about 5 different ways that you can actually do that. The first way, since Biden's proposal is not into effect, is to contribute to your 401k or even an IRA. Since we took a look at those different tax brackets, you want to make your income as low as possible. So if you are able to contribute to a retirement account, like a 401k or an IRA, then you're going to lower your taxable income, because then you will pay taxes on that amount when you are withdrawing that money. And if you're wondering why I didn't say a Roth IRA or a Roth 401k, there are differences between those accounts, between Roths and traditional accounts. So I did create a video for you. I will leave a link above and below in the description, and you can check out the differences and similarities between a Roth IRA and a traditional IRA. And the second item that I want to discuss is pretty cool. This is for low-income earners. So if you are retired early or you're on your path to FIRE, financial independence, retire early, and you plan on having a really low income, then this is going to be applicable for you. Or even if you are just in a lower paying job right now, if you're making about $33,000 a year if you're filing single, or $66,000 a year if you're filing jointly, then this would apply to you. It's called the Savers Credit. And you can deduct up to 50% of your contributions to different retirement accounts, including a Roth IRA, along with a 401k or a traditional IRA or a SEP IRA or a 403b, all different kinds of retirement accounts. The maximum that's available for joint filers is $4,000, and for single filers it is $2,000. So definitely look into this one if you are a low-income earner. The third one that I want to talk about is something a lot of people are not doing, and they could do it very simply, and it's going to drastically reduce their taxes. And this is to start your own business. It does not have to be a complicated brick and mortar business. It can be a very simple online business, and the startup costs can be very, very low, but you are going to save so much money in taxes by starting a business. I cannot emphasize this one enough. And I found an article where he broke down how much he was able to save on his taxes by starting a business. I found this on mywifequitherjob.com, and he kind of just goes over different things that you can deduct from your taxes if you have your own business. So I thought it was pretty cool. So he talks about you can deduct transportation and gasoline and oil costs. And he talks about housing and shelter. You can actually write off part of your house that you are using strictly for business purposes. That's super, super cool. And then he also talks about food and eating out. You can write off any business meals that you might have. He also talks about travel. If there is any vacation that you're going to take that is work related, then you can write off your travel expenses. Also, you can write off a portion of your utilities. And if you maybe buy a new computer for this business, then you can write off computer equipment and household furnishings, anything that you might have in the office. And then he adds it up all at the end. And he says in here that he was really conservative about it. But if you add up all of those different costs, then he was able to save $5,891.25. And then he says, based on an income of $63,091, it represents almost a 10% write-off on the American average taxes. So that's a huge amount, 10% that you can write off by just starting a very small and simple business. And he didn't even mention all of the things that you are able to write off by having your own business. I know for me personally, since I don't have a 9-to-5 job and I was paying health insurance premiums, I was able to write those off. Not only that, I chose a health plan that had a health savings account associated with it, and I didn't have to pay taxes on the amount of money that I contributed to my HSA. So seriously, if you want to reduce the amount you're paying in taxes, start a business if you haven't already, because you can write off so many different expenses. The government wants you to start your own business, so just do it. Comment below and tell me if you are going to start your own business or if you already have your own business. I'm curious to know. And the fourth item I want to talk about is charitable contributions. I really like this one because you're not only donating money or time, whatever it might be, to something that you really believe in, but you also get a tax break when you do that. So you can write off your tithing if you pay tithing, or if you are just making contributions to certain charities, then you can write that off on your taxes. And even the CARES Act that was passed made it really easy to write off at least $300 in charitable contributions. And if you want to write off more than that, then there's a little bit more work that you have to do on your taxes, but it's very doable. Giving charitable contributions not only helps someone else that's in need, but it also helps yourself, because I know I feel really good when I make charitable contributions. And you get a bonus with it because you get to write it off on your taxes. And number 5, the last one that I want to talk about is investments, in case you didn't guess it, because that's what my channel is basically about, investing your money. And you can write off so many things when you have different types of investments. And I just want to highlight a couple of things. Number 1, you can invest in real estate. I know for me, I actually rent out rooms in my house. I'm able to write off a number of different things in my house. If I need something repaired, then I can write off that repair. For example, I needed to fix the toilet in one of my roommate's rooms, and so I wrote off the cost in order to do that. And if you have rental properties, then you can write off even more things. If you buy a new furnace or a new water heater, I had to buy 2 new water heaters last year, actually, so that was a little expensive, but it's fine. It's totally worth it. But you can write off things like that, larger purchases that are going to improve the home, and you can depreciate that over time. You can also write off the interest that you're paying with your mortgage payment and any other expenses that you might have with your rental properties. So real estate investing is going to give you a lot of deductions. So I would highly recommend that if you have any interest whatsoever in getting into real estate. And I've created different videos about real estate investing, so you can check out those videos. I will leave a link below and above. Another investment is, of course, in the stock market. And I just want to point out that you can invest in a brokerage account. We've already kind of talked about investing in retirement accounts, But if you have money in a brokerage account, that means you can pull that money out at any time. You don't have to wait until you are at the age of retirement in your 60s. You can pull it out in your 20s, 30s, 40s, 50s, whenever. And all you need to do is pay taxes on that money. But here's the key. If you keep that investment for at least a year, you're going to pay a lower amount in taxes. It's called the long-term's capital gains tax rate versus the short term. So if you keep your investments for less than a year and you pull them out of your brokerage account, then you're going to pay the short-term capital gains tax rate. And let's take a look at these rates because this is really, really cool. This is going to play into paying $0 in taxes. I've pulled up the long-term capital gains tax rate. So this is holding your investments for at least a year. And this was for 2020. If you are single, then you are going to pay 0% in taxes if you have up to $40,000 worth of investments that you have pulled out of your account. So this is another way that you can actually write off that amount on your taxes and pay $0 in taxes if you're just living off of your investments. Hopefully you can see why it is so important to invest your money. Not only does it grow faster than keeping it in a savings account, but you get the tax write-offs as well. And if you are married or filing jointly, then it can be up to $80,000 that you're going to pay 0% in taxes. And we'll jump back up here. If you are single and you take out up to $441,450, then you're only going to pay 15% in taxes. That is so much less expensive than the normal tax rate. And if you're a baller and you are taking out $441,450, then you're going to pay only 20% in taxes. And we can jump down to the married filing jointly. If you pull out $80,000 to $496,600, then you'll pay that 15%. And over $496,600, you're going to pay 20%. And for the short-term capital gains tax rate, that's going to be taxed at your ordinary income tax rate, which we looked at earlier in the video. So most likely it's going to be less expensive for you to pay that long-term capital gains tax rate to at least hold your investments for a year. As you can see, if you are able to invest your money and then live off of your investments, you can pay that 0% in taxes and you can move to one of those states that has 0% for their income tax rate. So that is pretty cool. And then I've given you other ideas on how to reduce your taxes as much as possible. Any little tax deduction or tax credit that you can get really helps out because, as I've shown in other videos, even if you are just investing a small amount, so if you're able to save a small amount on your taxes and invest that money, then it will compound and grow so much over time that you can take advantage of having the 0% tax rate on your investments. Comment below and tell me which idea is your favorite on how to reduce your taxes. And if you liked this video, please hit that like button and share it with someone else who wants to know how to reduce their taxes. And hit the subscribe button to subscribe to my YouTube channel and hit the little bell to get notified on when I post new videos. Thanks so much for watching. I'll see you in the next video.